Hello, everybody. This is Luke Robinson, and I'm a business advisor here at Collective, your all in one solution for your back office. We do everything here at Collective. We'll handle your payroll, your bookkeeping, we'll turn you into an S Corp if you aren't already. And for a vast majority of our clients, we'll also handle their personal returns. So we pretty much do it all. But today, I am your host for a Tax Tuesday. And it's essentially an AMA. It's an Ask Me Anything over everything taxes. If you've ever heard any advice online, let's say from TikTok or just other social media channels that you want to verify or have ever been curious about, please feel free to ask me a question. And I think we already have some questions, which is exciting, of course. And the first one, okay, yeah, I get this one all the time when I talk to prospective collective members. Is do I need two different bank accounts as a sole proprietorship, or is that only when I'm an LLC? Well, here's the thing. Absolutely. If you're doing business, regardless if it's a sole proprietorship, if you're an LLC, if you're an S corp, doesn't really matter. If you are doing business, you need to have separate business bank accounts for that business. And yes, even if you're a sole proprietorship, um, as a sole proprietor, you typically can open up business bank accounts with your social security number. Or you can get an EIN number from the Internal Revenue Service. It's free. It's a free service. Don't pay anyone for an EIN number. Especially if you're just doing it yourself as a sole proprietorship, and you can use that number to open up a bank account. But absolutely, separate bank accounts for business activity makes accounting so much easier, so much more organized. It separates business and personal transactions. So when you have to do bookkeeping, or when a tax professional has to do bookkeeping, keeping them in separate accounts just makes it less error prone. The process can be done more efficiently and usually faster. It's just a lot better idea to have separate accounts when you have a business. Now, when you're a sole proprietorship, technically speaking, then they don't even these separate accounts don't even technically have to officially be business accounts. You can open up a separate personal checking account if you're running your business as a sole proprietorship. You don't have to get an EIN number. You can literally just open up a separate personal checking account and only run business transactions through that account. Now, once you became an LLC and became an S corp and made any sort of S corp elections, then you'd want to set up a separate account, get an EIN number, and use that to set up a separate business bank account. But when you're a sole proprietorship, you can set up a separate account, even using a personal bank account for business. Second question: do you need an LLC before you actually make any money? Well, with business in general, if you have a business, it's a good idea to set up an LLC. And yes, before you even start making any money. Because the thing is, when someone runs a business and when they start a business, it's a very common thing. It's a common occurrence that there won't be any money coming into the business for a while. Could be for several months. It depends. And if that's the case, what you'll still be doing though is typically you'll be spending money. You'll be investing into the business. So you'll be spending it on softwares typically. You might be hiring other contractors to help you get set up, to design some of your web pages. You might just be making general business investments, and that is business activity. And it's usually a good idea to set up an LLC before you start business activity. It doesn't really matter if you plan on making money just yet, but even spending money in the business, racking up business debts, doing general business activity opens you up to liability. And it's just a good idea to have that separation in place, which is an LLC. It separates your personal assets from your business assets. And typically, business creditors, people like that can't go after your personal assets. So absolutely, it's just a good idea to get an LLC set up as soon as possible. And if you've already started a business, even if you've made quite a bit of money already as a sole proprietorship before you've started an LLC, that's okay. Just get one set up as soon as possible. Schedule a call with us. send us a direct message on Instagram or whatever channel you happen to be watching this video on. Reach out to us and ask for a schedule link to schedule a call, and we'll go through your situation. We'll see, first of all, if you need an LLC, we'll set one up for you, and then we'll make an S corp election for you. Which brings me to my next question: is can you explain how you save money with an S corp? So here's the first thing about S corps. A lot of people have a misrepresentation, or they kind of have a wrong idea of what an S corp actually is. An S corp is a tax election. It's a federal tax election, and you have to be some sort of business entity before you can even elect S corp tax status. So LLCs can make an S corp election. Partnerships can make an S corp election if you have 2 or more people on an LLC. Corporations, C corporations, can make S corp elections. And what that does is, before you make an S corp election, let's say that you're a sole proprietorship. Even if you're an LLC, if you have an LLC set up, all of your money, typically speaking, is subject to the self-employment tax. All the money that you make, all the money that you net, your net income after business expenses, after all your tax deductions, after you pay your contractors, your software expenses, after you take the home office deduction, you get your net income. And before you become an S corp, or before you make an S corp election, all of your net income is subject to the self-employment tax. And the self-employment tax rate, as of now, is 15.3%. It might go up in the future, but right now it's 15.3%. And so, for example, before you become an S corp, let's say that you have an LLC and you've made $100,000 in net income. How you'd come up with your self-employment tax would be $100,000 times 15.3%. All of it's subject to that tax rate. But what happens with an S corp is, how you become an S corp is, first you set up an LLC. Then you file paperwork with the Internal Revenue Service, the IRS, S corp paperwork. Essentially, it's on a form called Form 2553, and you are asking the government to tax your LLC under S corp tax rules. And what that does is, technically speaking, that turns you into an employee. That makes you into an employee of your own business. You become employed by your own LLC. You are still the owner, of course. This is still your business. You're still listed as the owner on the company formation documents. It's yours. But for tax purposes, you literally become a W-2 employee. And since you're now a W-2 employee, your business pays you a salary. It pays you a wage just like you would make if you worked for someone else as an employee, or you work for another business as an employee. But the fantastic things about S corp is that the only chunk of your earnings that's now subject to the self-employment tax is your wage, is your salary. Whereas before, it was all your money. So, for example, like citing my earlier example, using $100,000, if you make $100,000, and let's say that you elect S corp tax status, now you have to pay yourself a reasonable salary. And let's say that with $100,000, let's just assume that $40,000 is a reasonable salary for you. Your salary, it's completely up to your facts and circumstances. It's completely it's individualized. But let's just make an assumption. And now with an S corp, that $40,000 is now the only chunk of your money that's subject to the self-employment tax. The other $60,000, or the rest of your money, outside of your salary, that is considered, or those are considered, distributions. And it's still your money. You can still pay yourself these distributions whenever you'd like. You can still access this money at all times. But this chunk of money is not subject to the self-employment tax at all. So, for that example, how you would come up with your savings is you'd take $60,000 times 15.3%, because that's the self-employment tax rate that you're saving on. And that comes out to $9,100, $9,180 to be exact. That you just simply do not pay over to the government anymore in self-employment tax. So it can be, an S corp can be extremely advantageous for a small business owner. What's the difference between a C corp and an S corp? Well, first of all, a C corp, that's a corporation. That's the technical name for that people think of when they think of corporation. That's a C corporation. And that's a business entity, obviously. An S corp is not a business entity. It's a tax election. So you have to be a C corp first, or an LLC, or a partnership if you wanted to elect S corp tax status. So a C corp, that would be more comparable to like an LLC, a business formation, a business structure. So if you set up for example, if you set up an LLC, then the IRS considers you a disregarded entity for tax purposes, which means, all your everything is done on your personal tax return. There are no business taxes that the IRS charge, or that they don't require, a separate business tax return. There's no double taxation, none of that. But when you set up a corporation, the IRS automatically identifies you, or they consider you a corporation for tax purposes. And what that means, if you're a C corporation, that means that you're getting taxed twice. You're getting taxed at the corporate level, the corporate income level. There are corporate income taxes. So when the business itself makes money, it's taxed. And then it's taxed again when it's paid out as income to the shareholders, either when it's paid out as salaries to you as a owner of the corporation, or your other employees. That money is taxed when it's paid out, and it's also taxed when it's paid out in dividends. When a corporation pays out money in dividends, and let's say that you own a corporation and you take those dividends, you have to pay taxes on those. So it's taxed twice, the money that flows through a corporation. But it is possible to set up a corporation, a C corporation, and then elect S corp tax status. And that actually turns it back into a pass-through entity, to where you can go on a salary and pay yourself out in distributions instead. And you save on the self-employment tax. You don't get double taxation. So it is theoretically possible to set up a corporation and then make an S corp election. But for a vast majority of and for a vast majority of small business owners, self-employed people, they need an LLC as opposed to a corporation, even if you're going to elect S corp tax status. Because when you have a corporation, there are additional requirements that an LLC just doesn't have. With a corporation, even if you elect S corp tax status, you have to have a board of directors. That's required. Those board of directors have to meet. You have to have annual meetings, and you have to record meeting minutes. You have to have other there are other corporate records that you're required to keep a hold of. And they're more expensive. The setup fees are typically more expensive for a corporation. They're more expensive for a tax professional to manage them. And the only reason why you'd want to set up a corporation as opposed to an LLC is if you eventually wanted to go public. If you wanted to, issue stock in yourself, things like that. And that just doesn't apply to a vast majority of small business owners. So I would certainly, in a vast majority of situations, it's better to set up an LLC as opposed to a corporation. How does the meals and entertainment write-off work? Typically, you can write off half, 50% of business meals. And usually with entertainment, especially with employee entertainment or client entertainment, usually you can write off all of that. But business meals, typically, like if it's a meal specifically for business, you can usually write off 50% of the business meal. Are there any advantage? Okay, I've heard that forming a C corp and making it to where the corporation income is zeroed out while paying yourself a salary is a strategy that a lot of self-employed people use. Your thoughts on this? So this question, what they're asking is, some people will set up a corporation, a C corporation, and in order to avoid the double taxation, what they'll do is they'll make these corporations books. They'll make the net income for the corporation itself zero. So there's no income tax for the actual corporation. And how they'll do that is let's say that you're a small business owner and you set up a C corp. Your salary, what you pay yourself in salary, is actually a business expense for the corporation. So some people, in order to avoid that double taxation, they'll set up a corporation and pay all that money out in salary to themselves. So the corporation actually doesn't pay any taxes. They just pay taxes on the salary end. And then they'll take, other retirement strategies into consideration, things like that, to further reduce their taxable income. But the reason that I would advise against that is because that's overly complicated. That's typically it's a much better situation to set up an LLC and then make an S corp election. Setting up a C corp is overkill. Most people just don't need to go public. They don't need to issue stock in themselves. It's just really not, usually it's not a good idea. All righty. Ooh, here's a good question. What are some tax deadlines that I should be aware of when I become an S corp? Well, first off, all the regular tax deadlines stay in place. For example, you'll still be required to pay estimated tax deposits when you're an S corp. That doesn't really change. You still have to pay quarterly deposits, and when those are due is the same as when you're a sole proprietorship or when you're just an LLC. And those are due the month after every quarter. So the quarter from January to March, those are usually due on April 15th. And then from April to June, that's usually due on July 15th, and so on and so forth. So those deadlines stay the same. The other deadline that you should be aware of, though, is the S corp tax return deadline. It's called when you make an S corp election, you have to file a business tax return. It's called an 1120S, and that deadline is March 15th of every year. It's actually a month before your personal tax return deadline, which is of course April 15th. But the S corp tax return is due by March 15th. So first of all, that's a completely new tax return that you have to keep in mind, but also it's another deadline that you'd have to keep in mind with an S corp. But thankfully, if you're ever a member of Collective, we'll take care of your S corp tax return. We'll take care of calculating your estimated tax deposits. So all these deadlines you won't have to worry about. You can just put that burden on our shoulders. And that can be really valuable when you're juggling 16 different hats as a self-employed person. Are there any drawbacks to an S corp? Well, it depends on what you mean by drawbacks. There are additional administrative requirements with an S corp. So, when you make an S corp election, there are several things that, kind of come into play that you didn't have to worry about before you became an S corp or before you made an S corp election. And one is running payroll. Before you become an S corp, you don't have to run official payroll. That's just it's not how it works. Like all the money that you make comes directly from your business, directly from your LLC. You can just pay it to yourself directly. It's pretty much, people call that taking owner's draws, and it's really simple to pay yourself. But when you make an S corp election, you have to run official payroll, and you have to pay yourself as a W-2 employee. And there are just additional steps that you have to take. You have to run it through a payroll processor. So that's one thing, is the payroll aspect. Another thing when you make an S corp election is the amount of your payroll. Your salary has to be reasonable. You have to pay yourself a reasonable salary. And that can be a little bit challenging to do on your own if you have to calculate that on your own. Another thing is your bookkeeping complexity goes up a little bit. The process of how you do accounting goes up in the sense that you have to now track a balance sheet with your bookkeeping. So whereas before, when you're a sole proprietorship or LLC, there is no balance sheet requirement, but there is with an S corp. So that's one thing to keep in consideration. Also, one thing is if you don't do things correctly, like if you pay yourself incorrectly, if there's other things that you mess up on, you could potentially increase your risk for audit. So that's one thing to keep in mind. And the fourth thing is the business tax return, the S corp tax return. That's the 1120S. A personal tax return, it's called 1040, but an S corp tax return, it's 1120S. And that's a complicated return. So that's another thing to keep in mind. But thankfully, with a company like Collective, we'll handle all that stuff to where you can still save money with an S corp, but we'll take all the annoying taxes off your hands, all your bookkeeping, your payroll, and things like that. So you still get the advantage of saving money with an S corp, but you have time to run your business, and we'll handle all the administration. With certain states have additional cost for LLCs. Are there ever situations where it's okay to run your business without an LLC? Well, honestly, that's just the answer to that question is up to you and just kind of how much you're comfortable with and how, risk averse you are and how comfortable you are with taking on risk. Because, it is true, of course, that different businesses have different exposure to risk, have different levels of exposure to risk. To whereas some, let's say that you're in the service-based business and you visit people's houses. Let's say that you're a pest expert, and you go and you provide pest spraying services to people's houses. That sometimes can be a little risky to where if the homeowner accuses you of doing anything in their house, like damaging any property, anything like that, there's just additional, liability that happens when you go to someone's home. For that situation, it would probably be a really good idea to have an LLC to kind of keep yourself protected. But let's say another situation like a life coach. Let's say that you're a life coach and you're just kind of doing it on the side. You don't have a lot of money that's running through it. In a situation like that, that would be a little bit more okay to run your business as a sole proprietorship because there's typically less legal exposure with something like that as compared to my previous example. But even still, though, with most of the cost with the state, with the LLCs, they're just not high enough that, in my opinion, it should prevent you from doing it. You just get such good liability protection with an LLC that in a vast majority of situations, and honestly, I might say all, it's a good idea to have an LLC in place for you so you can protect yourself and your business. Okay, so how do I rope rental properties under LLCs? And are there additional business formation strategies that I can use? Well, first off, I would probably with putting rental properties under LLCs, it's usually a good idea to go to like a Rocket Lawyer or a place like that and have an attorney handle that for you. You can do it yourself by going to your county clerk's office and recording the deed and things like that. It can be a little complicated. So usually it's a good idea to just pay. It's typically not very expensive with sort of those online legal services that you can go and have a lawyer just rope under the rental properties under LLCs. But I will say, in terms of just entity strategies that you can use for LLCs and rental properties, what I would suggest is that the entire point of putting in a rental property under an LLC is to insulate it, is to insulate the risk to where if someone like let's say that someone in a rental property falls and breaks their neck or breaks their leg or something like that and they sue you, um, they typically can only go after that rental property, the equity in the rental property, things like that. So what you should do is you should group properties under LLCs by equity. For example, by equity amount. Let's say that you have a house with a lot of equity. Let's say that it has the house is worth $750,000 and you have a $300,000 mortgage on it. That's $450,000 in equity, the house that you could potentially extract from the house. And let's say that you have another property that's worth $200,000 and you have a $200,000 loan on it, no equity. And let's say that you have both of those properties under one LLC. If someone falls and hurts themselves or sues you that resides in that low equity property house, then they have, since both of those properties are under one LLC, they have a right to go after that other property, even though they're not connected. But if you separate those type of properties from under different LLCs, like if you have a high equity property, put it under one LLC by itself, and put all your other properties with high mortgages on them with no equity, put them under their own LLCs. And that is all the time that I have today. It's a pleasure as always. And like I mentioned earlier, please, if you found this conversation useful, if you think that Collective might be a good fit for you, send us a direct message, and we would love to schedule a call with you. Go through your situation, see if you need to be an S corp, and see if Collective would help you. But that's all the time that I have this week. It's been a great Tax Tuesday as always, and I will see everyone next week, next Tuesday for our next Tax Tuesday.